There's been a lot of chatter about these budget changes. How are going to impact companies? How's it going to impact trust? How's it going to impact individual? Is investing even worth it anymore? Short answer is yes. We always want to invest. We want to set ourselves up for the future. But maybe how we invest should be kind of reconsidered. I had a question the other day around, if it's not super, what is the next best structure? Previously, it might have been personal names. Previously, it would have been potentially family trust. But this question in particular is, I've heard things around investment companies or bucket companies, investment structures. Are they going to be a fairly attractive vehicle in the future? And one of those, it depends. This video is general advice. It's important to get your own personal advice. But what's a investment company look like and what are the pros and cons? Some of the pros is that it's going to have a flat tax rate of 30%. Companies don't pay a tax rate typically higher than 30%, but also typically don't pay one lower than 30% if they're investing. If you're running a small business, those rates could slightly change, but let's talk about investing. And in this case, also important to caveat, I'm probably less talking about investing 50 or 100 grand. General mum and dad, put that money into super, go no further. What I'm talking about here is some of the clients we work with, for various reasons, business owners, family wealth, have substantial millions that are outside of super, and where's the best place that money to be invested? And I really do think investment companies should be considered as a way to do so. Company tax rate of 30%. Now that's higher than zero. Super, once you're retired, ideally set up at zero. We're going to take the zero over the 30. That's a no-brainer. If we have some accumulation in super, that's 15%. Still better than 30. But 30%, particularly when it's no higher, can be a fairly attractive tax rate. Now, in the past, one of the disadvantages of investing in companies is they didn't get a capital gains discount. Under the old rules, which are now going to be the old rules, you could sell an asset and only pay tax on half. Companies didn't get that benefit. So for some people, they were less attractive. But under these new proposed capital gains tax rules, when capital gains are going to have a minimum of 30% tax and potentially higher, up to 47, with some adjustment for indexation or inflation, but still that potentially is going to reset some of this framework here. And the other bit around that company tax rate is that's 30%. It creates what are called franking credits. Franking credits are tax credits that can be used in the future. So when a company decides to pay out some dividends, those dividends can come back and offset the personal tax you've got to pay. If your tax rate's at 30% or lower, you can actually get that tax back or a portion of the tax back. If your tax rate's 30% or higher, you might not pay any tax, or you might pay a little bit of top-up tax, but you're not paying the full rate of tax again. You get the credits for the 30% already. One of the key things, and probably the third, I think one of the most powerful things about companies, is from investing and from a dividend point of view, they have a tap. You can pay a dividend 1 year and not pay anything the next year. If you're investing in your own name, the income that earns, you've got to declare at your personal tax rate no matter what. If you're investing in a family trust, it's typically got to be distributed every year. If not, you're paying tax at 47%. And with the new potential changes to tax and trusts, you're paying 30% minimum and you've still got to distribute it. If all your beneficiaries are at 47%, that ends up being a high tax rate. Whereas if in a company, you could decide this year we've sold a property, we've made $1 million, we're going to pay 30% tax on that. But everyone else has got high personal tax rates. We're not going to send that through. We're not going to pay that out. So it allows you to turn that tap on and turn that tap off. Most other structures don't let you do that. And that's one of the benefits of having investments inside of a company. Who should be your shareholders? Who should be the directors? How is all that stuff set up? Again, it depends. It's a case-by-case situation. There's sort of some other complexity. Again, we're probably not running an investment company with a couple $100 grand. Just the cost of running it probably outweigh the benefits. But if we're talking about this is an asset that's going to build up, companies don't die. They can live on beyond you. So it can be a wealth vehicle, an asset vehicle to transfer wealth. And again, 30% might seem like an average tax rate, but it is an average tax rate. And if we're looking at wealth and family wealth and generational family wealth, maximum of 30% can be a fairly attractive tax rate. And again, only on the income or the realised gains. The assets in there obviously can be set up in an efficient manner as well. The other benefit of potentially investment company and what you're investing in, if it's in Australian shares, that they earn their own franking credits, you then don't pay tax again. Those franking credits count for that 30% your company might need to pay. The question posed to me was, will this be the best investment vehicle in the future? The short answer is no. Super is still going to be the best. But if we've capped out super, we can't get any more into super, or if we have the wealth that we're all our super limits, we're looking at other vehicles. I think the attractiveness of companies, which we have used for a while for different clients for different reasons, but I think is going to be a lot more attractive than perhaps it has been in the past, and perhaps will go up the rung and be more attractive than investing in family trusts. Again, still set up slightly differently, have the pros and cons. Important to talk to an accountant or a qualified advisor like ourselves. The accountants here or the advisors here have some accounting experience. The business itself has a tax agent license. We don't actively give accounting and tax advice, but we are qualified to do so. It's important to make sure you're working with an advisor. It's not just about the investments, it's what vehicle those investments are in. It can have a big impact on the tax that you pay, and also importantly, the tax that future generations pay. Short answer, I think they are going to be much more attractive and potentially second in line for substantial wealth after super funds. Hopefully that's helpful. If you want to get in touch and have a chat, feel free to reach out to us at financialedgegroup.com.au.